Ladies and gentlemen, good day and welcome to the Tinna Rubber and Infrastructures Limited Q4 and FY2024 earnings conference call hosted by Vinstra Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand over the call to Tanuj from Vinstra Securities Limited. Thank you and over to you, Tanuj.
Thank you. Good day, ladies and gentlemen. On behalf of Vinstra Securities Limited, I welcome you all to Tinna Rubber and Infrastructure Limited Q4 and FY2024 earnings conference call. The company is today represented by Mr. Gaurav Sikri, Joint MD, Mr. Subodh Kumar Sharma, Director and COO, Mr. Ravindra Sabra, CFO, and Mr. Anup Arora, Senior Vice President, CPG and BD. I would now like to hand over the call to the Managing Director of the company, Mr. Gaurav Sikri, for his opening remarks. Thank you, and over to you, sir.
Hi, good afternoon. This is Gaurav Sikri. Am I audible?
Yes, sir.
Okay. Hello, everyone. Welcome to the earnings call of Tinna Rubber and Infrastructure Limited for the fourth quarter of the financial year ending 2024. First off, I would like to thank our host of today's earnings call, Vinstra Securities, for hosting this earnings conference call. Now, let me take you through some of the key operational highlights of the fourth quarter and also the financial year end 2024, and after which my colleague Subodh, our CEO, will take over and give details about the financial performance. It gives me great pleasure to inform you that our company continued on its growth path in the financial year ending 2024, recording around 23% growth year-on-year in consolidated top line, 70% growth in EBITDA, and 85% growth in net profit. Our EBITDA margins have improved from 12.42% in the previous year to 17.25% in FY24. This financial performance is a testament of strategic roadmap laid out a few years back of diversifying our product portfolio and building a pan-India presence for our business. In other developments for the year, we improved our working capital cycle, improved our credit rating, and reduced our interest costs. These improvements in our financial performance have led to a significant increase in our return ratios as well. On the operational front, in FY24, our consolidated tire crushing volumes grew by 44% year-on-year, while for the fourth quarter under review, the same increased by 30% year-on-year. Though there was a 10% rise in input costs due to the prevailing issues in the Red Sea area. In FY24, the infrastructure segment contributed to 52% of our revenues, while industrials followed by 25%, steel contributed to 13%, and the balance 10% revenues came from consumer segment. In Q4 FY24, infrastructure segment witnessed a growth of 60% year-on-year, which is attributed to the accelerated highway construction across the country, which has now surpassed 12,000 kilometers this year. In the industrial segment, we witnessed a growth of around 45% year-on-year in Q4 FY24, driven by higher sales in exports, where we have started exporting recycled rubber materials to leading multinational tire companies and have further appointed agents in Thailand, Japan, Taiwan, and USA. The consumer segment witnessed a growth of over 100% year-on-year in Q4 FY24, with volumes increasing by 150% year-on-year from rubber mats, brake pads, and other consumer applications. Lastly, the steel segment witnessed a growth of around 12% year-on-year, which is an outcome of higher tire crushing capacity across our plants. In other developments, the company has made a strategic investment in solar energy to set up 1.2 megawatt of solar power. This is expected to generate 1.6 million units annually contributing to annual savings of 1.25 crores. This plant is scheduled to be operational by Q2 of the coming financial year. On the capex front, during FY24, we commercialized our Oman facility in July 23, which has generated revenues of around $1.5 million and EBITDA of $170,000. Furthermore, Tinna incurred a capex of 45 crores for setting up greenfield projects, namely a passenger car tire recycling plant in Maharashtra, a plastic and rubber composites facility at the existing plant located in Panipat. Our R&D activity is full on to develop customized products for diverse applications like footwear and auto parts, and we anticipate commercial sales to commence from second quarter of FY25 for our elastomers business. Lastly, I am very happy to inform you that the Central Pollution Control Board recently directed all producers to fulfill their assigned EPR obligations for the fiscal year 23, and this has resulted in our company monetizing and selling some of the EPR units that we have earned to the tune of 6.6 crores in FY24. It is to be noted that Tinna is one of the largest recyclers of end-of-life tires in Asia and a prime contributor of India's circular economy plan, and we will continue to benefit from the EPR policy, which is now fully operational. In conclusion, let me reiterate our vision for 2027. We remain completely committed and focused towards achieving it. To reiterate, it is our aim to reach revenues of 900 crores by FY27 and achieve EBITDA margins of 18% plus and return on capital employed of over 30%. We strongly believe that with the current economic and government tailwind, as well as higher consciousness by all stakeholders on circular economy, Tinna is poised to see this vision through. With that said, I now request the board to brief you on the financial performance of the company.
Good afternoon, everyone. Thank you, Gauravji. Let me first brief you on the fourth quarter financial performance first, followed by the performance of financial year ending 2024 on a consolidated basis. The operational revenue for the fourth quarter of FY24 stood around INR 110 crores, which grew around 51% year-on-year basis. EBITDA reported around INR 22 crores, which grew up over 200% year-on-year basis, with the EBITDA margin standing at 20.47%. Net profit after tax reported was around INR 16 crores, which grew by 130% year-on-year basis, and the PAT margin stood at 14.29%. Coming to the performance for the financial year 2024, the operational revenue were around INR 364 crores, which grew by approximately 23% year-on-year basis. The EBITDA stood around INR 63 crores, which is approximately 70% growth on year-on-year basis, with EBITDA margin stood at 17.25%. PAT stood at INR 40 crores, which grew by approximately 85%, and PAT margin were reported at 11.10%. I am also pleased to announce that STRIL has paid an interim dividend of Rs 3 per share, and the company board has recommended a total dividend of Rs 5 per share for financial year 23-24. With that, now we can open the floor to the question and answer session. Thank you so much.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. First question comes from Nirav Seksaria from Living Root Analytics. Please go ahead.
Yeah. Am I audible?
Yes, Neeraj, you're fine.
Yeah. Hi. Could you mention about the capex plan for FY25?
I'm sorry, could you repeat?
Could you specify the capex plan for FY25?
We expect to continue with investing in new capacities as well as in some process improvement related capex. I believe we will see a capex of anywhere between 30 to 40 crores in FY25.
Okay. And so your aim for FY27 was to have 10 operational plants, right? So how are we going to move forward with that since we need to open 4 new plants?
We are evaluating a variety of options as we speak. I cannot disclose more today on this call, but we are continuing to analyze, and we already mentioned that we are committed to our vision of 27, which is to reach 900 crores of top line. Now that could come in a new physical location. It would come in addition of plants in our existing facility because we have the opportunity to use the base that we have already existing. We have 5 locations that we operate from. All of them have ability to be expanded. So it could come in any form or manner.
Okay. And could you also specify the percentage of exports as a percentage of revenue?
Give us 5 seconds, we will come to you on that.
About 8%, I am Ravi Sabda, CFO. About 8% is our export turnover, 24 crore during this year.
FY20. Okay. So to follow up on that, so we import like 60% of our tires. So with the recent introduction of EPR, for which Tinna is direct benefactor of, so would we plan to increase onto our domestically procured tires? Could you explain me the unit economics if that is much more cheaper for us?
No, it's more complex than that. We will, however, to answer your question, we are always looking to have more localized sourcing of tires because that is the most environment-friendly form of recycling as well. But yes, not at a disadvantage to our overall economics.
So for FY25, can you expect what percentage can you expect for the domestic procured tires to be?
It is impossible to predict and tell you that.
Okay, but we can expect it to narrow down going forward, right?
Like I said, we will just be guessing.
Okay, sure. Thank you.
Thank you. Next question comes from Rishi Kothari from Pi Square Investments. Please go ahead.
I'm audible?
Yes, Rishi, please go ahead.
Yeah. First of all, congratulations on a good set of numbers. And one of my questions is around the Red Sea crisis that we are right now facing in terms of exporting of tires. So what percentage of cost that you in a way mentioned that it's a 10% increase in cost? So because we are more dependent on the export based tire material, right? So if we, what is the problem that we are facing in terms of being domestically used end of life tires? Is it that the domestic players are not, being used somewhere else, or is it something different?
Firstly, your voice is coming to us not completely clear, but if I've understood correctly, your question is about Red Sea. On that, the crisis in Red Sea continue to impact us with some erraticness in the schedules, as well as it has a cost impact, which we are doing our best to pass it on to our end consumers, and we continue to look at alternate options for processing raw materials. We fortunately have a fairly large base of supply between domestic as well as overseas, somewhere Red Sea is not does not play a role. So that is our hedge on the Red Sea issue.
Okay. Okay, got it. And also one more thing, the recent agreement of exporting the raw material crumbs to the crumbs to the foreign players in the tire industry or industrial segment. Is this for the tire manufacturing, right?
Yes.
Okay. And also in terms of debt, if we talk about, are we any plans of reducing that debt, the books that we have right now currently?
So we are continuing to service our debt in an efficient manner. At the moment, debt is a very good option for us as access to capital, and I don't see us wanting to reduce our debt in any accelerated fashion.
Okay, so in a way we'll continue the pace of increasing the debt in the book because it is in a way good leverage position for us.
In routine, Rishi, and in fact, if our capex plans, we see opportunities, which are compelling. I'm not adverse to taking on a little bit more term debt on our books because our balance sheet can support it.
Okay. Yeah. Thank you.
Thank you. I request the participants to restrict with 2 questions in the initial round and join back the queue for more questions. Next question comes from Abhishek Singhal from Naredi Investments. Please go ahead.
Good afternoon, sir. Thanks for the opportunity. So my first question, we open a company in Netherlands. So we import used tire or export our product, and in near future we establish a plant in Netherlands.
Abhishek, the Netherlands company is not yet operationalized. It is a dormant company. Our imports or exports are not connected to this company. This vehicle has been set up as an investment vehicle for any other overseas investments and opportunities that we see. But at this point, this company is not operationalized.
Okay. And in our presentation, solar power, 125 million annual savings from solar power plant. And you mentioned 1.25 crore annual savings.
The saving will be 1.25 crore. That's the accurate number. If you have picked up this number mentioned differently, then it's probably a typing error. We will look into it.
Okay. And in FY24, we earned 6.6 crore from EPR. So is directly going to bottom line or any expense for incurred this income?
No, there is no expense directly related to EPR. The impact of this comes in the top line first, and then it drops down to PBT.
So what is the per kg rate for EPR certificate?
The EPR rate is very fluid. I don't wish to get into details on this call on the prevailing price. It's extremely volatile today. We have only begun this process very, very recently. I would recommend let the market stabilize a bit more, and then we can share more information with you.
Okay. Thank you so much.
Thank you.
Thank you. Next question comes from Pradeep Rawat from Yogia Capital. Please go ahead.
Yeah, good afternoon to everyone, and thank you for the opportunity. So my first question is regarding the margin. So earlier the company used to have a single-digit margin, and now we have high teens. So can you please explain what has changed internally as well as externally since that pre-COVID period up to now?
The margin improvement has happened on various accounts. It has happened in us moving to a category of customers who value quality and service more than just price. We have improved our margins because of some product lines that we have developed, which enable us to get better margins because they deliver fantastic economics to our end customer, products like MRP. as well as operational efficiency. So all of these have contributed, and we continue to see a lot of opportunity in, for example, operational efficiency, which we hope to harvest the benefits as our business goes towards our target sale of 900 crores in FY27.
Yes, sir. And what has improved externally? Can you please explain a bit about it?
Externally, I would only put it to generally better economics, better economic activity in India. The demand for all products is robust. Government spend in infrastructure is at an all-time high, which has a direct impact on our business. So those factors have contributed immensely as well.
I'm just jumping into the conversation. If you see our overall growth from the infrastructure sector, that has contributed well. So, in the last financial year, we have done, fabulous on the infrastructure side. And if you see, the overall even bitumen consumption has gone up by 10%. India imports around 3 million metric ton. In last financial year, they have imported around 4 million metric ton of bitumen. So around 0.8 to 1 million metric ton bitumen consumption has gone up. So that means more infrastructure is being built, under process, and the more and more demand is coming. And modified bitumen is the reality, and that's the reason, you see our overall crumb rubber sale, our overall revenue generation from the infrastructure sector is improving, which is up by 3 to 4% as compared to FY23.
Yeah, great. Understood. And my second question is regarding the revenue generation from our new passenger car radial tire facility and composite facility. So how much of revenue can we generate from these facilities in FY25?
So if you see, that's the overall teamwork and the efforts management has put into, start this Varle facility in Bombay. It's in the record time of 6 months we completed, and by end of February, the plant came into the operation. The first month, it took us to, fine-tune the production, but still we could make around 3 crores rupees of revenue generation from that. But ultimately, the benefit of this location will come into the notice in the FY25, and we expect to generate approx 75 to 100 crores of top line from this new facility.
So I think there is a typo in the presentation. There is mentioned 7.5 to 10 crores. So, yeah. So the utilization would be somewhere around 60-70% on this plant.
Yeah, this capacity is around 60,000 tons per annum. So around 5,000 tons of tire it can handle every month. So we expect a total revenue out of this location is somewhere close to 75 crores to 100 crores in between.
Okay, and my last question is regarding the extended producer responsibility. So how much of the total revenue is coming from this extended producer responsibility contracts?
Sorry?
Yeah, so I think that we generate revenue from producers also. Those producers are they will give us contract on basis of recycling their. Sorry, I will get back to you on that question. My next question is regarding the EPR credits. So how many EPR credits did we generated in FY24?
We will be generating annually between 80 to 75,000 credits basis our current business model. And that's all I can share at this point of time. There is still a lot of work being done with the CPCB and the Ministry of Environment on the weightages, etc., as confirmed on different product categories. So some of those things, there is still some changes expected, But at this point of time, our business could generate between 50 to 75,000 pesos.
Okay, I'll get back into the queue. Thank you.
Thank you. Next question comes from Viraj Mahadevia from MoneyGrow India. Please go ahead.
Hi, Mr. Sekri. Congratulations to you and the management team on a fantastic finish to FY24. Given the new capacity added in Q4, you mentioned that there will be a ramp up during FY25. At full capacity utilization, how much could you generate in revenues out of this facility?
The Varlia facility, hi Viraj, nice to meet you again.
Likewise.
The Varlia facility with the capacity that has already been created, this plant, as the board indicated, will generate between 75 to 100 crores of top line. The basic plant footprint is for more equipment, more machinery, more kind of projects to be put within the same premises. So,
okay.
The number you have dialed is currently busy. Please try later. आपके द्वारा डायल की कृपया कुछ. The number you have dialed is currently busy. Please try later.
The number you have dialed is currently busy. Is what is happening?
I'm sorry, just a moment, sir. Let me check.
Yeah.
Yeah, participants, kindly stay connected.
Yeah.
I welcome back the management team. Please go ahead, sir.
Yeah, hi Viraj. Did you get the
Hi.
answer?
No, it went on to hold. But I think you were mentioning that you have the ability to add capacities at Varlia. So if you can pick up from there, please.
Yes, Varlia site has ability for us to add more equipment and more plants in it. But with the capex that we have already done, that will result in top line contribution of between 75 to 100 crores.
Understood. And how much can you debottleneck Varlia for, and with what investment approximately?
There is no debottlenecking.
I'm sorry, brownfield expansion. How much can you do?
A lot, Viraj, a lot. It's a large premises with an ability to ramp up quite a bit. It's a large.
My second question.
Just to give you a perspective, Varlia is a 13-acre site versus our next largest plant is our Chennai plant, which is only 5 acres.
Okay, understood. So my second question was regarding EPR. Where do you source your used rubber tires from? Is it with direct tie-ups with the tire manufacturers, or it's sourced from the retail channel? And then does that inventory sit of raw material on your books, or does it sit on a tire manufacturer's books until the offtake in time for processing?
So we have multiple options of sourcing. Some are with tie-ups with tire companies, some are with tie-ups with aggregators, some are with tie-ups from PROs, which are producer responsible organizations. But the inventory, once we take ownership, sits obviously on our books.
Right. Okay. Okay, sir. Thank you. All the very best.
Thank you.
Thank you. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. Next question comes from Ritesh Polaria from Girik Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, on you have processed about 99,000 tons of tire. I think that you can generate anywhere between 60,000 to 75,000 credits only. So the weightage for your tire crunch is lower than the other processes. Is that understanding right?
Ritesh, we have an as importers of end-of-life tires, we also have our own obligation of EPR units as well as credit. So net available to sell is the number that I indicated to you. It could be between 50 to 75,000 EPR units after meeting our own obligation.
Okay. You have to utilize some of obligations for yourself also.
That's correct.
So what is the gross generation you can do on the 1 lakh ton capacity?
Ritesh, I have described the policy to you. Further details, it is a bit too early for me to share. I would prefer let 1 or 2 quarters pass by, let the policy settle, and then I think we will share more details with you.
Okay. Sir, I'm sure it's too early, but this 6.6 crore of EPR generation, is this for part or you have sold the entire obligation for this year?
We have part sold.
Your part sold. Sir, so remaining unrealized EPR credits, do they find a place in balance sheet or how do you record the entire EPR transaction?
We have chosen to take a conservative view on accounting of these credits, a bit like how companies also treat carbon credits. In our mind, they are of value only once monetized. So that is the path we have adopted.
Okay. Would you like to comment on what is the ongoing price of the EPR, or is this a negotiation? And this 6.6 crore, have you sold to the OEM or through intermediary?
So our sale has been achieved by a direct sale. We are in touch with, as you know, all the tire companies. We have an ongoing relationship. So we have not, at least at this point, found the need to use an intermediary. I'm not ruling it out for future. And what was your other part of your question?
Yeah, that is more or less answered. Sir, last one question. Sir, assuming the regulation, I'm sure it will evolve over a period of time. But is all the tire manufacturers, they have to procure the EPR? So generation of EPR is enough, or demand is far higher than the supply?
See, the obligation of tire companies as per the policy is on a staggered basis. And as the years pass, their need for EPR units will increase because their obligation will increase. And that is where the market sits today. Like I said, it is still very early for us to already develop a sense of, whether there is more demand or less demand. I suggest we let 1 or 2 quarters pass, and we'll all have more clarity on this subject. But see, what is certain is that government has come up with this policy. It's on the producer pays principle, which means the producers of any kind of waste, electronic or tire or any other kind, have to be made accountable and responsible for their waste. And if a recycler is doing its job or doing a job on their behalf, then the recycler deserves to be compensated. And that is how this whole policy is based. So we are on the right side of policy. Honestly, the operationalization of this policy has happened faster than I expected. I credit the Ministry of Environment and the Pollution Control Board, who have, in my view, done a fantastic job. We are very familiar with EPR policies in many different countries, and I think what India has come up with is easy, crisp, clear, very transparent, and kudos to the people who have worked on it. So we are benefiting from this. Please understand that our business model is not based on this EPR. Our business is robust and strong, independent of EPR. Of course, it is a fantastic benefit to have, and we will ensure that the company benefits to the fullest extent. But beyond that, it is very hard to comment on specific questions today because it's too early.
So that's very great to hear. But this EPR is changing the dynamics of the entire recycling industry, not just in tire, but everywhere. Is the recycling attractiveness going up, or you think that the economics over a period of time will adjust to the new reality?
I believe that, government, by announcing a EPR policy, has brought in added incentive for people to see this industry very carefully, and entrepreneurs, should see merit in recycling. I mean, we were always looking to expand our business. Our Vision 27 was made irrespective of the EPR policy, and now this is an added sort of, it is like wind beneath our wings, to make us dream even higher and bigger.
Thank you, sir. I request the participants to restrict with 2 questions in the initial round and join back the queue for more questions. Next question comes from Pritesh Chheda from Lucky Investments. Please go ahead.
Yes, sir. I have 2 questions. One is your incremental capacity of Varle at 60,000 tons. Why is the revenue intensity different from the existing capacity? Is there any product line difference in the two?
There is some difference in the products that we will produce in Varle versus our other factories because it's a different material that we are starting with. These are PCR tires versus our other factories are largely built to process truck and bus radial tires. So there is some difference.
So the current factories process truck and bus radial, and this is going to process PCR.
It is going to process passenger car radials, correct?
Okay. So for the 60,000 tons, you have invested what capex?
It is approximately 30-35 crores.
So 30-35 crores will be given a revenue range of 75 to 100 crores.
That's correct.
And the main product line difference between a TBR and here will be what? So you'll have the variant of the rubber, which is the crumb rubber and the micronized rubber and all that.
We will firstly have less steel. The PCR has less steel versus TBR. That is one difference. Second is we have a third element of nylon, which we do not usually get in TBR processing. And even the rubber composition is a bit different because largely synthetic rubber is used for manufacturing of PCRs, whereas natural rubber is used for manufacturing of TBRs.
Okay.
As a result, the end products are also have different kind of benefits in the recycled rubber materials.
Okay. That's why it is 16 rupees, whatever a kg that the realization comes out, versus 35 plus in case of the existing. Okay. My second question, and this is the last question, is is there any product line difference between Q1 and Q4 when your margins have moved from 15% to 20%? Or is it that the EPR related benefit is being booked in this quarter because there's a 6 crore, did it even out? If you could just explain the product mix and the margin.
So the EPR monetization has happened in Q4.
Okay, so now that explains the 6 crore, the entire 6 crore came in Q4?
That's right.
Okay, then it explains my confusion. Okay, thank you very much.
Thank you.
Thank you. Next question comes from Sandeep Desik from Arziv Partners. Please go ahead.
So in your presentation, you have mentioned that, can you hear me, sir?
Yes, you're audible. Please go ahead.
In your presentation, you have mentioned that the opportunity for the infra is 5x in 3 years. Right?
Yeah. Yes.
If that is the case, why are we looking at only 5x in 3 years roughly works out to whatever, 70%. Yeah. We have a 60% market share there. Why is your revenue guidance only 25% then?
See, in the infra, I mentioned the overall bitumen consumption in India is somewhere close to 9 million metric ton, and we estimate approximately 10% is the market for modified bitumen. So right now we are seeing, the market is somewhere around 200,000 tons of modified bitumen. So we have a more headroom to grow in this space. But number two, if you see my product on the infrastructure side goes right on the top of the road, and that level comes after 3 to 4 years once the contract is awarded. So if you see in the last 1.5 to 2 years, there is a lot of traction in the infrastructure side, and that's the reason our contribution, the infrastructure segment is giving much better growth as compared to the other sector. And, in the road sector, because the road infrastructure in the last years under the leadership of Mr. Nitin Gadkari has performed very well. In the last year, we did almost 12,000 kilometers of highways, which is a record. Last year, where the bitumen consumption is also a record by 9 million metric tons. So we see it is also a reality, like, the government will repeat, and all these developmental work will keep happening on the space at which it is currently happening. So we see there's a big headroom for us in the next 3 to 5 years, or maybe more, for the infrastructure sector.
Okay, so if my understanding is that this 5x in 3 years that you have mentioned in your presentation is for the road sector, infrastructure sector, not necessarily for our product, Tinna Rubber's products. Is that correct?
Sorry, Gaurav here. I'm jumping in. We see this opportunity for us. We do see this opportunity for us. That is the opportunity which exists. Of course, some things have to fall in place for this opportunity to turn into a reality. Government has been encouraging use of modified bitumen, rubberized asphalt, but the adoption has not been as fast as we would like. We have seen some accelerated pace of adoption in the last 1 to 2 years. So if that trend continues, we will be short of capacity and we will be needing to add capacity.
Okay. So just to conclude, 25% CAGR has a significant upside risk rather than downside risk if the infrastructure kicks off the way you expect it to. Am I correct? Would I be correct?
Absolutely, sir. Because even the large road contractors tend to have their own preferences. We have recently won over a contract of one very, very large and significant road contractor who for the last decade was resisting using rubberized asphalt. So we expect such trends as assumptions, and as they happen, then the potential is 5x is what we have mentioned.
Okay. Got it. Thank you, sir. That answers my question. Thank you.
Thank you. Next question comes from Amit Kumar, an individual investor. Please go ahead.
Congratulations for great set of numbers, and thank you for giving the opportunity. So first question is regarding EBITDA margin and PAT margin for Q4. EBITDA 19%, PAT at 12.8%. So can we take the same? Can we achieve the same EBITDA and PAT margins in FY27? And secondly, in the presentation, the revenue guidance is 25%. But if I calculate from 363 crore in FY24 and go to 900 crores in FY27, it's coming 35%.
So we see year on year exactly what will be the growth is very hard for us to predict, sir. We have grown from 295 crores in FY23 to 363 crores in FY24. Our earning guidance for FY25, we have already mentioned in our earlier calls, is 500 crores. So in order to achieve that, it's simple math. We should be hitting 120 odd crores a quarter, right? Quite quickly. So a lot of that work has already been done. We expect to grow, at a pace where we can get to 900 crores to meet our vision. Now, in some years we would go faster, and some years we go a little bit slower. But ultimately, we want to get to 500 in this year and 900 by FY27.
Okay, thank you. And second question regarding that, can we maintain the same 19% EBITDA margin, 13% PAT margin, or there is a room to improve this by FY27?
So there are so many uncertainties in this world. Nobody can guarantee what you are asking me to commit on this call. We are delivering what we have said so far. All our efforts, our initiative are in that direction. And I think you just have to wait and see our results to have that validation.
Okay, thank you, and all the best for the future.
Thank you.
Thank you. We have a follow-up question from Viraj Mahadevia from MoneyGrow India. Please go ahead.
And Mr. Secretary, if you could spend a few minutes to talk about the Oman setup. How are you all pleased? How are you all feeling about the market opportunity there? Is it getting bigger? Is competition increasing? And where are you in utilizations currently? And where do you see that going over the next year?
Hi, Viraj. So Oman is, our experience, to give you the short answer, has been very good. The plant was commissioned in record time. The product economics has worked out exactly how we thought it would. There is limitation to growth in Oman because it is a small country. It is a country with small population, so they, as a result, have not a very large base of waste tire generation. Saying that, there are only 2 or 3 players, and we are one of them in Oman, and we are the dominant one. That is the lay of the land of that country. The plants are already operating at about 80-85% efficiency. We are now exploring to see what are some niche opportunities to grow further in Oman. But we don't dramatic increase in Oman capacity because it is basically a small country.
Understood. So it's eventually, in the next year or so, it will become a cash flow business rather than a growth business. Understood.
Yes. It is already cash flow positive, just to be clear.
Right. Perfect. Thank you. Any plans to expand in any other geographies nearby in the region, Africa or
we are looking at India,
Middle East?
Overseas opportunities. We are now a bit more confident, of overseas opportunities after having successfully commissioned Oman. So we are not taking anything off the table.
And this would be organic and inorganic, or only organic?
Absolutely. Any opportunity which is viable for growth, we will look at it.
Understood. All the best.
Thank you.
Thank you. We have a follow-up question from Nirav Seksaria from Living Root Analytics. Please go ahead.
Yeah, hi. Thanks for the follow-up. So could you mention the capacity utilization for FY24, sorry?
FY25 capacity utilization for us?
FY24, sorry.
FY24. FY24, we are at about 75 to 80%.
Okay. And so if we are setting up any new brownfield project in India, so can we expect the cost to be around 40 to 45 CR based on the last project?
See, we believe that our capex spent in this financial year will be around that 30 to 40 crores in the current financial year. It could come in just, it will not necessarily be one large brownfield. It could be in 2 or 3 different opportunities.
No, so I'm saying that if we go for a brownfield project, can we expect the cost to be similar to the previous one?
Yes and no, because it is not, it's hard to say that we will set up exactly the same PCR type recycling plant. So it could be a different kind of tire recycling. It could be a different form of recycling also. But if we were to do the same plant again, I guess, yes, the cost will be the same because we just set it up last year.
Okay. And the 6.6 CR that we have received from EPR, is that for FY24 or is that inclusive of FY23 too?
This is for FY23.
FY23. And when are we set to receive the EPR for FY24?
We will continue to monetize, our EPR units. We have some remaining of FY23 as well, and what we have generated in FY24, and we will generate in FY25. It's an ongoing process, depending on supply demand. As we see an opportunity, we will monetize.
Okay, sure. Thank you.
Thank you. There are no further questions. Now I hand over the floor to management for closing comments.
Thank you. Thank you all for participating in the earnings call today. I hope we were able to answer your questions satisfactorily and at the same time offer insights into our business. If you have any further questions or would like to know more about the company, please reach out to our investor relations managers, Valorum, And thank you so much again for your time. Stay safe and stay healthy. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Vinstra Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.